Well, good morning, everyone. We have reached the last chapter of our textbook, Fundamentals of Taxation, and here we are looking at corporation. So corporations are legal entities and they're formed under the laws of a state. So corporations for tax purposes and legal purposes are treated as a separate entity. We are required to use accrual basis for corporations for tax purposes unless we have average gross receipts of 25 million or less for the last 3 years. Then these small taxpayers can benefit from cash basis accounting. Corporations can choose a fiscal year, so they don't have to be calendar year like individuals. They file Form 1120. And unlike the partnership, corporations have to pay taxes. So this is where we go into double taxation. So the corporation has to pay taxes. The dividends that are distributed to shareholders are not allowed as a deduction, and the shareholders have to pay taxes on those dividends. The tax return of a corporation is due the 15th day of the fourth month after year end. So corporations pretty much, if they have a calendar year, will have a due date same as individuals of April 15th. And then they can apply or file an extension to file the return on the October, 6 months afterwards. So again, just like individuals is an extension to file, not an extension to pay. So any payments must be made on April 15th if we're talking about a calendar year corporation. So corporations with a June 30 year end must file the 15th date of the third month after year end and have a 7-month extension. So on formation, we looked at the partnership and we said on formation, there was no tax for the most part, no tax consequences. Now, in terms of corporations, if the transferors, the shareholders that are forming this corporation, immediately after that transfer, they control 80% or more of the corporation, then there's no tax. But if they own less, then they'll have to pay tax on formation. There are two exceptions to the 80% rule, and that's if a shareholder contributes an asset that has a liability, and the release of that liability and the amount of the liability exceeds their basis. Another scenario where it could cause a shareholder to have to pay taxes will be if they receive a boot in the form of cash or other property. So we have two examples here. We have Gina, who transfers an apartment building to a company upon formation. Her basis is 100,000. The fair market value on the date of the transfer is 500,000, and there is a debt that will be assumed by the company of 300,000. Because let me just grab my handy pen here. Because the amount of the debt exceeds her basis, then that means that she'll have to pay taxes on this gain, on the difference between the debt that was released and her basis. In this other example, Ernie, he contributes a property with a basis of 15,000 and a fair market value of 25, and he receives cash. So this is the boot. He receives something in exchange, which is going to trigger the gain. And so the gain will be calculated as the lower of the difference between the basis and the fair market value of the property, or the cash that was received. So in this case, the cash is the lowest, and that's the gain that they'll have to recognize. Oh. Okay, so pretty much just like the partnership, the basis of the contributed property to the corporation is the same as the basis that the shareholder had, plus the only difference is that we're adding any gain that's recognized by the shareholder. So this will be the inside basis, what the corporation basis is on that asset, versus the outside basis, which is the shareholders basis. And the shareholders basis is calculated as the property contributed plus any gain recognized minus anything that they have received in exchange. And after that, pretty much we don't do anything else with the basis. We're not going to increase it by any separately stated items. First of all, because there's no separately stated items for a corporation. So the shareholder will not receive any information from the corporation for tax purposes aside from the dividends. Okay, so there is no adjusted gross income for the corporation. So in terms of the tax formula, this is going to be a little bit slightly different. We have that gross receipts. We begin with our gross receipts. So it's pretty much like the income statement. Beginning with our gross receipts, we subtract our cost of goods sold to arrive at gross profit. And then, different from financial reporting, we're going to add our portfolio income or any other income to arrive at total income. And then we get to subtract any necessary and ordinary business expenses that are tax deductible, and that will equal our taxable income. And then we can also allow to, if we have any net operating losses, we can go ahead and subtract that, and dividend received deductions, which we're going to cover in just a minute. And that will equal finally our taxable income. And the applicable rate for corporation is just a flat rate of 21%. And this will be our tax liability, which we are able to reduce if we made any prepayments or we have tax credits, which will ultimately equal our tax due if we still remaining an amount due, or a refund if we have overpaid. So differences between the individual tax return and the corporation are basically the ones that we're going to mention in this presentation. The first one will be capital gains and losses. If we're still netting our capital gains and losses just like we do for individuals. However, net capital losses are not allowed for corporations. So remember, the individual, they were allowed to deduct $3,000 up to $3,000 of net capital losses that exceeded capital gains. But in this regard, for corporations, they can only deduct capital losses up to capital gains. So if their capital losses exceed capital gains, they're going to have to carry that over. Actually, they have a choice. They can carry back 3 years or they can carry forward 5 years. And this is another difference compared to the individual. The individual is allowed to carry forward indefinitely, but a corporation only has a 5-year window to take advantage of that capital loss. Another item that's different from the individual is that if they have net capital gains, these are not taxed at preferential tax rates. So you don't have to worry about that anymore in terms of the corporation. Net capital gains are taxed as ordinary. So it will be subject to the 21% tax. Okay, another difference is the charitable contributions. For corporations, these are limited to 10% of taxable income, and we'll have to make some adjustments. The taxable income, if it includes charitable contributions, if we deducted charitable contributions in arriving our taxable income, we will have to add that back, because what we're looking for is taxable income before charitable contributions. And then we're going to have to add back dividend received deductions and any carrybacks. And again, if we have an excess of charitable contributions that we were not able to deduct in the current year, then we can carry those forward for 5 years. So 5 years again was the threshold for capital losses, carryover, and charitable contributions. And so here we have an example. Zabo company reported $50,000 of taxable income before charitable contribution. So I don't have to subtract the charitable contribution from this because it was not included in calculating the $50,000. The company had charitable contributions of $8,000. And so we are limited to 10% of the 50,000, so we can only deduct 5,000 of our 8,000 contributions. And so that means that the remainder that we were not able to deduct in the current year will carry forward to the following year. This is also different from the individual, which is for corporations that own or have stock in other corporations that are domestic corporations, they are allowed to receive a reduction of those dividends. So unlike individuals where we receive the dividends from the corporation and we are taxed on those dividends, maybe these dividends are qualified dividends and the preferential rates apply, we're still subject to double taxation. And so for corporations that own stock in other corporations, to give them a break from double taxation, we have the dividends received deduction. So if the corporation has owns another corporation, and depending on the ownership percentage, so if it's less than 20%, they will be allowed a 50% DRD. If it's between 20% and 80%, less than 80%, it will be 65%. If it's 80% or more, it will be 100%. Now this DRD may be limited. We're going to look at some examples next. We have the Duck Corporation owns 25% of Rose Company. Okay, so 25%, that falls under the 65% bracket. And Duck received a 10,000 dividend from Rose and is entitled to, okay, so if we take, so this is the amount of the dividends is 10,000. We have a 65% DRD. And so that means that 65% of that will be our dividend received deduction. So that means that in essence, we are paying taxes on the difference, which is $3,500. Okay, so we have saved ourselves $6,500 of paying taxes on that amount. Now let's assume that instead of 25, we own 15%. That means it's less than 20, and the DRD is 50%. So 50% of the 10,000 is 5,000. So only we will pay taxes on 5,000 of the dividends, and the other 5,000 would have been reduced by the DRD. In our second example, we have a company that owns 30% of another company. So we're still dealing with the 65% DRD. And so they paid a dividend of 20,000. We have taxable income of 50,000. And so 65% of the 20,000 is 13. So out of this 20,000, we're only paying taxes on 7,000 of the amount of dividends. Now let's assume that we have the same facts, except that our DRD, the company's taxable income is 5,000 instead of 50,000. And so the DRD may be limited if the taxable income is between 65% of the dividend or 100% of the dividend. And since the taxable income is less than the 13,000, it doesn't fall within these parameters, then we are not limited on the amount of DRD that we're able to deduct. So in the case that, for example, the taxable income was 15,000 instead of 5,000, that will fall within these parameters, and that means that the DRD will be limited. Okay, other items that pertain to corporation will be organizational expenses and startup expenses. So organizational expenses could be like legal costs associated with the formation of the corporation, their articles of incorporation, their bylaws, etc. Startup expenses would be anything that's related to pre-opening costs. Maybe we have some training for our staff and things like that. Okay, and so these will be amortized over 15 years. Now there is an election that they will be able to kind of speed up some of those expenses depending if they meet certain thresholds. Corporations also have to make estimated tax payments. If we recall, for individuals, they were also required to make estimated tax payments if, let's say, I'm self-employed, so I don't have withholding, then I have to make quarterly estimates. So the same thing for corporations. So corporations have to make estimated tax payments. In order to avoid the underpayment penalty, they have to pay the lesser of 100% of the tax due for the current tax year or 100% of prior year, whichever is less. And then the payments are due on the 15th of the 4th, 6th, 9th, and 12 months. Now, if a corporation has a net operating loss, if it was generated prior to 2017, in 2017 or earlier, it can be carried back 2 years and therefore 20. However, in 2018, under the new law, NOLs are limited to 80% of taxable income, and they can now be carried back. However, this has changed due to the CARES Act, so you may want to take a look at that. Now corporations are allowed to carry back their NOL. But your textbook, it's dealing with the 2018 tax law under the TCJA, so we're following this rule. So Wilson Company was formed in 2015, and in 2018 they happened to have a net operating loss of $10,000. So this will carry, they cannot carry back, they have to carry forward. And so in 2019 they have 8,000 of taxable income, so they can use up to 80% of taxable income to offset their NOL. So 80% of their taxable income is the $6,400 and so they can only reduce their taxable income by this amount. That means that they will have to pay taxes on the difference, and then whatever they have not used, the 3,600, will carry over to 2020. Okay. Transactions with shareholders. This is just kind of like FYI. Basically, corporations, have earnings and profits, and so it might be in the interest of the corporation and the shareholders to keep track of these earnings and profits, because when the corporation pays dividends, then we need to ascertain for tax purposes what's coming out of earnings and profits, which will be treated as a dividend versus a capital contribution. Okay, so this is what the earnings and profits, the importance of earnings and profits. So we'll leave that for another time, and we'll concentrate on Schedule L, M1, and M2. The Schedule L is basically a balance sheet. So if you're looking at your Form 1120 and you go to the fourth, fifth page, you'll see the Schedule L, which is basically the balance sheet with beginning balances and ending balances. So not much there. The M2 is basically your retained earnings, the equity, the retained earnings beginning with the carryover from the previous year, adding the net income from the current, and subtracting any distribution to shareholders. The one that's a problem for students is the M1. And what the M1 is basically a reconciliation between book income and taxable income. So this whole presentation we talked about differences between, or differences that pertain to what's acceptable or deductible for tax purposes. And so there were certain limitations, like 10% of our charitable contributions, the dividend received deduction. There are also others too that we did not mention, but they are the same as the individuals, like meals and entertainment that are subject to 50%. It could be Keyman life insurance. So sometimes companies insure their top executives, and so the insurance premiums that are paid on these policies are not deductible. The corporation is not allowed to deduct. And we also talked about depreciation, where we said we're going to use makers for the most part for depreciation for tax purposes, but for financial reporting purposes, we can choose, straight line, sum of the year digits, double declining balance, etc. So there's going to be differences between what we're reporting on the tax return and what we're reporting on our financials. So here's some we have in terms of this reconciliation. We have some items that are positive adjustments, meaning we begin with our book income, okay, straight from the income statement. And then we're going to have to add some items that we subtracted in arriving at that book income for financial reporting purposes, but that they are not allowed for the tax return. So for example, if our book income is net of any income tax expense, we're going to have to add that back. If in our book income we subtracted any capital losses, we're going to have to add that back if we don't have capital gains to offset it. In our book income, we subtracted X amount of charitable contributions, but these are disallowed for tax purposes because they don't meet the 10% threshold. There could be instances where our book depreciation under straight line or any other method exceeds our total tax depreciation calculating under makers. And we may have permanent differences like the 50% on meals and what else did I explain? The Keyman life insurance and things like that. Okay, things that could be subtracted uh, in calculating our taxable income could be life insurance proceeds. So, like I said before, the life insurance premiums are not deductible for tax purposes because the life insurance proceeds are not taxable. And so we may have included the life insurance proceeds in our income under financial reporting, but for tax purposes, we're not gonna include it in our taxable income. So that needs to be subtracted. Maybe instances where our tax depreciation exceeds book depreciation, and so we need to subtract from book income. Okay, so these are just reconciling items. So basically we're reconciling how did we go from $1 million of book income to 680,000 of taxable income. We're just trying to reconcile these differences and we're reporting those on the Schedule M1. Now, if we're a large corporation with total assets of 10 million or more, then instead of using the Schedule M1, we will have to report it on Schedule M3, which is more comprehensive. Okay, so here's an example of the Schedule M1. So we have Martin Company had book income of 50,000. So our starting point for the Schedule M1 will be our book income. So we have here book income per books. Now let's assume that we did not include any income tax expense on this 50,000. So we don't need to add back any income tax expense. If it was, then we will have to add it. And so we begin with items that income subject to tax that was not recorded on the books, or expenses that were recorded on the books but were not allowed for tax purposes. So that could be an excess, that could be charitable contributions. Okay, in this case, we have a meal. And meals are subject to 50%, so that means that 50% of meals will not be allowed for tax purposes. Okay. On this side, we have items that we recorded on our books, but that we're not reporting on our tax return, or deductions that were we don't have it for book, but we have it for tax. So those instances could be the depreciation when tax depreciation exceeds book depreciation. This will reduce our book income. Okay, and we have a contribution for tax purposes that was carryover from the previous year, which of course we don't have in our books, but we're deducting for tax purposes, so that's added there too. So in essence, this 50,000 comes from the income statement, and the 47,000 should equal our taxable income on page 1 of Form 1120. Okay, once again, this is just FYI. For financial purposes, if a corporation owns 50% of other corporation, they are required to consolidate. For tax purposes, that threshold is 80%. And so the advantages of consolidation is that we may have a company that has losses that can be offset against another company that has taxable income. Okay, so the result is that we connect those two and pay less taxes. So that's the advantage of a consolidated return. And once the election is made, we cannot it's irrevocable. Other issues that we need to look at is the brother and sister group. This is only a concern if we have 5 or fewer persons that own 2 or more corporations. I'm not going to get in detail into this, but basically it must be disclosed on the tax return. There might be some limitations as Section 179 and things like that when under this scenario. The last item on the agenda is the business interest expense limitation. Actually, I have one more, but business interest expense limitation, and this is just applicable to large corporations that we're going to limit the interest expense to 30% of adjusted taxable income plus the interest. So the interest expense is only allowed to the extent that it does not exceed business interest income, because it expense before, plus 30% of the adjusted taxable income. Okay, and adjusted taxable income has basically is our taxable income modified by these items. And the disallowed interest is carried forward indefinitely. It is not applicable to businesses that have 25 million of annual gross receipts or less. Okay, the last item I promise is the S corporation. I just want to briefly mention it. S corporation is very similar to a partnership. It's a flow-through entity. S corporations do not pay taxes. The shareholders do. And they receive or they file a Form 1120-S, which is more of an information return, just like the partnership. And so this means that as shareholders will receive a Schedule K1 with their separately stated items, their ordinary income or loss. One thing that's different from the partnership is that there's no self-employment for the S corporation. So if the shareholder works for the corporation, then they will receive a W-2. So that's probably a more important difference between the S corporation and the partnership. Another difference is the limitations that the S corporation has. So the S pretty much stands for a small corporation. And so we have these requirements that have to be met. Otherwise, the corporation will have to dissolve or lose its S corporation chapter or election. So first of all, in order to be an S corporation, you have to form a corporation, a C corporation, just like any other corporation, and then you make an election. Okay, so that pretty much completes this presentation on corporations. So the connect assignment will be posted sometime today. Okay, thank you.